Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin, the Chief Currency Analyst here at HYCM. Just as folks are coming in, I'm going to be just going through the disclaimer. And the important reason for this disclaimer is that the whole point of this workshop is to show you guys how I trade and how I trade using professional techniques, using professional resources, and just helping you to see, as it were, look over my shoulder of a professional trader so you can see what exactly is going on in my thinking process. And so the whole idea about this is that you can begin to make decisions for yourselves and you can be understanding what moves the currency and commodity and equity markets. Now, one clear thing to say is even though we'll be looking at different entries, different exits, take profits, stop levels, the whole idea of this workshop is not a signal service. In other words, I'm not advertising trades for people to take. Now, the reason for that is very important, and it's a very important learning point, which is market conditions change rapidly. And a lot of my trading scenarios, I often put in what will make that trading scenario change. So market conditions are liable to change, particularly at the moment with so much tension between US and Iran. So it's important to begin to understand.
1 p.m. London time. We're doing a quick rundown for our US listeners.
Apologies,
overnight during the Asia Pacific session, equities posted gains across the.
There we go. Get rid of that voice. So, hello, welcome, Akeem, Yue, Van. Good to have you back, Van. Lovely. Hope you have a happy new year. In the session ahead, just want to go through what we're looking for. If you look at your GoToWebinar control panel, you will see a handout session. If you just click on the handout guide, you will click on it and you will see this. Now, this special topic we're looking at today is what to do in quiet markets. And I've organized this simple sheet. Although it's simple, it's designed to be comprehensive with these 5 bolded titles: looking forward, looking back, looking at the charts, looking at your risk, looking at the outcome of your trade. And the whole idea is that you use these 5 pillars as checking points as you look at your trading, when you're going to trade, what you're going to trade, how you're going to trade it. Just use these as a brief summary. Just print it out, put it on the side of your desk, and you can use it. This is what I do every single time I'm trading. I always do these 5 things. They've become second nature to me. So just as a way of helping people who are just trying to get to grips with trading, I've put this there, and it's helpful for whatever stage you're trading at. That's a helpful document to have. That is under the workshop guide, January the 7th, underneath your handouts. So be aware of that. Now let's go back to the presentation. And in the presentation that we have ahead, the special topic we'll be looking at is what to do in quiet markets. A very, very important lesson, and we'll be covering that during today's session, as that can help with some trading psychology. Now, the handout for the session, we've covered that. That's on the GoToWebinar control panel. If you have any suggestions that you would like, please do email them to me. That's my email address, and you can present those suggestions. Maybe there's a special topic you'd like covered. Perhaps there's an aspect of the market you don't understand. Maybe there's something you keep hearing being referred to as you're reading analysts and you're reading, different FX news websites, but there's one aspect that you don't quite understand. Well, why don't you just email that topic to me? Because I'm very happy to do suggested topics. So if you have an idea, just jot that email address and send me an email. So as we get stuck in, let's have a look at the market context at the moment. Now, I just wanted to quickly do a recap for the pound, okay? Because we have had the withdrawal agreement passing through the Commons. So if you look here, we had the UK elections, Conservatives have won the majority, and the Prime Minister withdrawal agreement bill has been passed through Commons, okay? So now we're in this period now waiting for the UK to completely leave the EU. Now, as it stands at the moment, there is question mark whether the trade deal can be agreed and whether it's likely to be ratified by December 2020. So there is a period now, just under 12 months, where the UK is trying to finalise its Brexit deal. So if you thought Brexit was gone, think again. Brexit is back in the market's mind, and the market will be carefully considering the relationship between the UK and the EU. So that transition period now is set to last until December 2020. So now there's going to be negotiations about the future relationship between the EU and UK. Okay, and at the moment I will just show you what's going on in the UK House of Commons today. In the Commons today, there is a House of Commons committee stage of the EU Withdrawal Agreement Bill. It's expected to pass and to be voted on Thursday, but the key focus for the pound at the moment is on Wednesday. We've got the new EU Commission President von der Leyen will be in London to meet UK PM Johnson, okay? And she will speak at the London School of Economics as well. So the UK wants to have a quick deal to avoid any cliff edge scenarios, which is over here, okay? The cliff edge scenario would be if there isn't a trade deal ratified and the UK has to leave the EU without a trade deal. Okay, so that would be seen as a bad outcome and a difficult situation for the UK, and so that would be very pound negative. So if the UK manages to agree a deal with the EU, and that's all agreed before December 2020, that will be positive for the pound. Okay, so that's the big picture that's now driving the pound. Going into the election, it was, would the Conservatives win? The Conservatives won. We saw the pound rise, and now Brexit is being reconsidered from this perspective. Okay, so the thing to watch now very clearly is this: watch the future EU-UK's relationship, because those reports will now move the pound. And tomorrow we have a key meeting taking place. Okay, so could expect some pound volatility tomorrow, so be aware of that. And let's just have a little look at the pound. We'll just see how the pound has been moving. So essentially this was the spike on the Conservative majority win. Okay, we had this strong move up, and it was from around here in October when PM Johnson kind of announced that they had a withdrawal agreement bill and everything was going pretty strong. Then we had a range for quite a few number of days. Range broke, and analysts were touting this 1.3500 level. That has been capped. Since then, you see, it was a buy the rumor, sell the fact response. And since then, the pound has been sold off, okay? And we've still got some selling action on the pound. And now we're kind of stuck in this new range, this 1.300 to 1.3500 range. So what we're looking at here, for any further pound moves in the near term, what we really need to see is some good news about the EU-UK relationship. So focus in on that for the pound, and whatever stage of negotiations, you'll start to see the pound being moved and pushed around on that basis. So just a quick reminder, as we start January 2020, you might have thought Brexit has dead. Sadly, Brexit is not dead, and the UK will be carefully negotiating with the EU, trying to arrange a good deal. And if that good deal is arranged, then expect more bids in the pound. So that's just something to be aware of at the start of the year. The next thing that I wanted to look at gold for the start of January 2020, because we've seen some very strong bids in gold in the last few days. Now, this was a commodity that I was flagging up, and I put out a video when price was about 1480 for HYCM, and I was just, you can just see a couple of things that I wanted to note for gold was that, in a low interest rate environment, gold has been bid. Now, gold has been bid strongly from all the way down here around December 2018. Gold has been bid strongly all year, basically all through 2019. And those strong bids came on concerns over the US-China trade deal. Okay. Now, there was a number of factors that were really kind of stacking up for gold here, and you can see this kind of trend line that was broken. You can see a kind of ascending triangle was formed, and that was just looking like that was going to break out. It has now broken out, and we had the price spike up here to these highs. Now, I've closed my gold longs. I was long from about 1480 and I closed them at 1572, I think it was. Okay. Now the reason for closing it was just it was such an extended move. Markets don't move in straight lines forever. So, the gold market is quite extended. See this profit taking all the way up here, and those market doesn't tend to move in straight lines. So, I just took the profit. That was a nice profit. I had stops below the lows, so it was a nice, decent trade, and it was just 1572. Now, gold is still on my radar, and I'll explain to you what is going on with gold. What part of the reason for this strong bids. There's two things that were taking place here. The first thing is the seasonal demand for gold. Now, if you look at this table, this is the table of gold's performance in each of the 12 months of the year for the last 10 years. And if you look at January, you can see that gold has been bought for the last 6 years in January in a row. So 3.5% up in 2014, 8.39 in 2015, etc., etc. These are the gains. Now, this strong bids for gold in January, and you see the strong bids for gold in August, that is not a coincidence. There's some seasonal demand reasons for these bids. This is a seasonal factor. Often with commodities, certain commodities are obviously in more or less demand during certain times of the year. So, for example, in the UK, there's going to be more demand for, gas during the colder winter months because people need to heat their homes. It's very simple. Now here, the reason for gold demand in January and August is for a similar social reason, but slightly different. There's the Chinese Lunar New Year, and there's a tradition of giving gold, and those physical demands for gold increases gold prices. You can see it's been quite a reliable trade year after year. In August, there's a similar phenomena with festivals and Asian weddings taking place in the month of August, again, seeing a seasonal demand for gold. So that's one of the first reasons for gold being bought. That's why I was interested in buying gold around the end of December. And you can see that for the last couple of years, that those gold moves in January have been front run by gold moves in December, as exactly the same happened this year as well. For 2019 December, we saw, strong moves up in gold. I think it's about 3 or 4% up, if memory serves me correctly. Okay, so we've also, what's added to that has been these safe haven bids. Okay, so you can notice it was on Friday of last week that we saw this strong move up here. So price was sort of making its way up fairly steadily, but it was on the Friday of last week where we saw, look, a move up from 1525 up to around 1585 and above. Very strong, fast, hard move up. Okay, we can just go down to a smaller time frame so we can just see those more rapid moves. Okay, you can see here 3rd of January, strong move up, and then a strong spike up on the 5th of January here when the market opened. Now, this was the trigger. The trigger for that was US President Trump directing the killing of a top Iranian general, Qasem Soleimani, in a drone attack at Baghdad airport during last Friday. Okay, so this event has really sparked a volatile situation in the Middle East. Now, you've probably seen the news today that the funeral of Qasem Soleimani has resulted in a stampede and a number of people being injured, and I think around 40 people actually dying in a strong stampede during his burial. Now, the reason that's important for us as commodity traders, obviously, it's a very sad situation, war and destruction. But for us as commodity traders, sadly, it sometimes results in solid and good trades. And this is sadly one such example. So on the weekend, we had a number of reports coming out from Iran saying they were going to step back from the nuclear deal. There was wide expectations of a retaliation from Iran. And the market was really on a wait and see mode today, because what was widely expected is that once Mr. Soleimani had been buried, they were expecting there to be a retaliation from Iran after the funeral, a kind of, get the funeral done and then we'll retaliate. So that has been to see as the pathway. Now, what's happened today is with the stampede at the funeral, the burial of Mr. Soleimani has been delayed. So the market's kind of breathing a sigh of relief, because most people are thinking that the timeline, as it were, is burial and then revenge. Now, the Iranian government have outlined 13 different ways they see of hitting back at the US. So this is the key bit. Iran is expected to strike back, but the timing of that retaliation is not yet clear. But any aggressive strikes by Iran will invite more gold buyers. So one of the key things to be aware of, when you look at those strong moves in gold, this has been a market that's really moving, okay? If the Iranians do strike back, then I'm expecting more gold buyers at market. So obviously, if you have a squawk service, this is, one very simple trade to be looking out for, to be by your squawk and waiting for some kind of response from Iran. And then I'm expecting to see instant gold bids. Now, the extent of those gold bids will also depend on the extent of Iran's retaliation, and also whether that retaliation is likely to re-engage the US, because President Trump has said, I will, they've identified, I think he said he's identified 52 Iranian targets. So as you can see, the situation is volatile, and basically the general view that the market is taking is that they don't think that this is going to get out of hand. However, it doesn't mean it couldn't. So Iran doesn't want a full-out war with the US, and the US doesn't want a full-out war with Iran. So neither country is seen as wanting to antagonize each other to the point of all-out and open conflict. So most people think there's going to be a natural holding back. There's going to be a natural kind of thing of that happening. Oh, sorry, my apologies. I just got distracted. Something popped up on my screen. I think I accidentally hit a link or something, and something popped up on my screen that I wasn't aware of doing. It seems to have gone now. So, let's come again. I'm just going to get. Oh, there, I've got it. Yeah. Okay. So the thing for us to look at is, will Iran strike back? Okay. If we get that strike back, I'd be expecting gold buyers at market. So that's really one thing to look at. Now, the other thing for us to look at is oil. Okay, I'll just explain to you the situation with oil. You can see that in a very similar way to gold prices, we've seen oil prices being bid. Now, normally on a risk-off market, you'd expect oil prices to fall. Now, the reason oil prices have increased here is for the very simple reason that the concerns have been, see, this was the attack, was that if Iran is dragged into a conflict, that conflict will spill over throughout the Middle East. So Saudi Arabia might be dragged in, there may be Iraq, issues for Iraq, UAE, Kuwait, etc., etc. And if you put those Middle Eastern countries together that might be affected, I think it's about 68% of OPEC's oil production could be impacted by a conflict. Now, this is what's important to say. At the moment, there are no supply issues with oil, okay? And we know that with OPEC Plus meeting, that the market has been oversupplying oil and have agreed to cuts. So the general picture for oil is that the market is well supplied, okay? So you can see that's partly reflected in this price action here yesterday. Price moves up to the 64 level and then sells off because the market is not really convinced that there's going to be big supply issues with oil in the longer term fundamentals. So this is my outlook for oil. On the short term, any further strikes is likely to find oil buyers at market, but those strikes are likely to be, those increases are likely to be limited, okay? So obviously the extent to which supply is hit will affect the extent to which oil prices go. Now let's go back to September, right? This is the September price action when there was a drone attack on one of the largest production facilities in Saudi Arabia. So the drone attack happened, price spiked up to 63 pretty quickly and then sold off, okay? And what many market participants at the moment are expecting a similar kind of price action to occur, okay? Now, whether it will occur or not, I'm not sure, but what I wanted to make you aware of is that most major analysts, JP Morgan, UBS, they're not expecting supply issues to really dog this oil market. So I'll just show you because it's helpful to see. I'll show you this was the trade that I took on oil, and it's what I teach. It's a very simple method. So I was long gold, and so my long gold were just moving nicely on the 3rd of January. But I came to my desk and I saw the huge price in oil, could see the reason, could see the concerns. So as I teach, when you get the surprise event, you don't want to be buying up at the highs, okay? So I drew a Fibonacci retracement level on the actual price spike. I then traded it back to, and it went up to this one, I remember, and then price traded back down to the 61 Fibonacci level. I teach just taking it from the 50%. The reason I took the 61% is it just corresponded with these recent highs. So you can see there was a nice horizontal support, resistance turn support here. I'll just draw the level in. So, I don't make it complicated with my trading. I like to keep it nice and simple. And then price turned down. I think I got filled in 62, 32, 33 is where I got my fill. And then when I held the trade into the weekend, because it was one of those volatile situations when we were waiting for a possible response. Now, if there was one thing I was pretty certain of, is that there would be some kind of response from Iran. So I was expecting more bad news. So I held my oil longs over the weekend. The market gapped in the open. I came in to the market when price was up at these highs. I came in sort of 7 or 8 in the morning, and I just took my profit up here, 64 something. Okay, I can't remember now on my account, but I made sort of just over 1 and a bit % on my account by trading that gold, not that gold, but that oil long. So I took profits on gold and oil longs, but any aggressive strikes, and we're likely to get another move, another leg higher. So what I'm looking for now is I'm looking for market moves. Now, let's say, for the sake of argument, there is some further aggressive move and price spikes up again. Say it spikes up, to 60, 65, and you get a similar kind of price action. Then the thing to look for is if you've missed that initial move, is what I tend to look for. As long as the reason is sound, like it was here, look for pullbacks to the 50% or the 61% Fibonacci level. I prefer the 50%, it's simpler, and then just take profit at recent highs. So if you were trading it here, say I was trading it here in a very textbook, simple way, and I would have gone up from here to here, just put the swing, the stops will be below this part here, enter at the 50% retracement level, and take profit up at these recent highs. Now, don't take profit at the very highs. See, there's a 64 big round number. Just take profit around the shoulders, because often price will tip into those shoulders and then might pull back down. I know it went through in this instance, but oftentimes it just, profits will be taken just here at the shoulders. So that's the outlook for oil. Okay, I just wanted to cover that because it's really, really, really important moves that we're seeing at the market. Okay, going back to the handout. Remember, we want to do these things, we want to look back. So we're now going to look at some more recent sentiment and for the day. And the first thing we want to remind ourselves is what happens with risk on and risk off markets. We've been seeing risk off markets recently, but with the exception of US oil would normally depreciate, but it hasn't in this situation because of the supply issues. It's obvious, isn't it? If there's less oil coming to the market, then that's going to push oil prices up. What we always want to do, we want to pair a strong and a weak currency against each other. Imagine you had to guess which of your favorite sports team would win. Now, I don't know which sport you like, but one of the sports I like is rugby. And imagine, for this, just for the imagination, imagine if the England rugby team were going to play a schoolboys under-18 rugby team, okay? There would be no contest because the England team would be far superior to the boys, physically, athletically, their stamina. You would expect the England rugby team to win every single time. That's exactly the principle that I'm trying to employ in my trading day to day. I want to pair a strong currency against a weak currency because that way I know the currency pair is more likely to move in one direction than another, okay? So looking at the European session, when I came to the market this morning, there was a one currency pair that looked obvious for shorting, and that was the Australian dollar Japanese yen pair. I was expecting the Australian dollar to be weak and the Japanese yen to be strong. Now, obviously in a market that's very sensitive to risk at the moment, that makes sense for Australian dollar to be weak. Also, there was a report out by the investment bank ANZ. They were expecting Australian dollar weakness as the cost of the Australian fires is expected to have a short-term negative impact on labour data. We know how the RBA sees labour data as very important, and Reuters saw it as a drag on the economy for December and January, and so the market's pricing in a 56% probability of a 25 basis rate cut in February, okay? Then, on the other hand, I was expecting strong Japanese yen strength on risk-off flows, because the concerns about the US and Iran conflict escalation, they were really quite high this morning. They've receded a little bit now with the news that the burial of top Iranian general has been delayed. So let's look at the charts, okay? Once we've got our pair, weak Australian dollar, strong Japanese yen. Now we look at the charts. And that is the same outlook that I'm looking for in the US session at the moment. So let's look at the charts. Once we've got our pair, we've got the reasons for it. And now we see where we have now. Okay, so we see this strong move down as we're expecting in the current risk-off tones. Now, looking at this pair this morning, where would have been a sensible place to go short? So if you came to the market this morning about 6:30 a.m., the sort of places that I would have been looking for shorts would have been up here at this pivot point, 75.05. I know price didn't get there, but that would have made a lot of sense to me. And then looking at the 1 hour chart, you can see prices moved down and fallen into this recent support level. So where I've been looking for shorts now on this currency pair, we go back to the 15-minute chart, I'll be looking for shorts back up here in that 74.80 region. You can see that if you take the pivot point off, we've got a pivot point there, but just draw a Fibonacci retracement level. We can draw a fib level in there, and you can see that there's 74, this 74.80 level here. Okay, we've got the 50% Fibonacci retracement level, we've got a pivot point, and we can put off stops above the 75.40, maybe the 75.49 level. Sometimes it's good to have your stops just above the second most obvious point. That's the most obvious point. That's the second most obvious point. Giving the stops a bit of width can help you get unnecessarily stopped out. And then potentially where I look for profit taking, we'll be taking profit down at these recent lows here, 75.55. So there's potentially, 45 points there. So that's what I'd be looking at. So I've got my currency pair, got the weak against the strong. I've then applied my technicals. You can see we've got the horizontal support level here. We've got a pivot point up at that level as well. We've got 50% Fibonacci retracement level. And if that level held, then I would be expecting potential more sellers here. So I'd be expecting sellers from 74.80, 75, and all the way up to 75.20. Okay, that's what I expect sellers in those three regions. So that is what I'm expecting for the US session. Now, obviously, what's the risks to that trade? Well, the risks to that trade is that there's some really good positive sentiment, that there's some good news that comes into the market, and that really buoys the situation. So that's one thing to look at. Looking forward, at 3 p.m. in an hour and a half, we have ISM non-manufacturing PMIs. So one of the key things to realize with the non-manufacturing PMI is, let me just drag that across. Okay, this data point, last week we had some manufacturing PMI of the US, and it showed weak reading, like the weakest reading since 2009. Okay, so if one thing that the market is looking at, will there be another weak reading tonight? This is going to have a potential impact for the US dollar and for risk. So be aware of this event, and that could potentially affect the Australian dollar, Japanese yen trade as well. So I've just got an alarm set at 74.80 on that pair, and I want to see what happens with this figure here. If we get a low reading, then I'd expect some US dollar weakness to enter into the market. So just be aware that that is a bit of a market focus for the week, and arguably the most important scheduled data point. Obviously, we've got non-farm payrolls on Friday as well, which will be important. But so looking forward, you've always got to look forward. What's going on? What's coming up? Now, if there's a dovish sentiment shift, I would then be looking at US dollar CAD. Okay. Now, if we get weak data out of that non-manufacturing release at 3 p.m., one key pair to look at is the US dollar CAD pair. We've got CAD strength on the oil strength. Remember, CAD is very closely correlated with oil. What's good for oil is good for CAD. So CAD is being supported by that strong oil price. If we get a weak data point out of the US, then potentially expect some more weakness in the US dollar Canadian dollar pair. So that's what I'm looking at for this afternoon as well. So, okay, guys, that's enough from me. What trades are you looking at? What are you looking at for the session? I'm just going to go and shut the door in my office. And just while I'm doing that, I'm going to give you a moment to very quickly jot down some questions in the question panel about what trades we're looking at. Just give me a second. I'll be back in a minute. And if you pop in the trades you're looking at, we'll look at them together, go through them, and see what to do. Okay, let's just have a look. Thanks for bearing with me there. I'll just check the chat panel as well. Okay, guys, I don't think anyone has any questions. Just very quickly then, as we're going through, I'll give folks another moment to ask any questions. But otherwise, just remember, I haven't covered this for a while, is don't forget to look at your risk, okay? Looking at your risk is probably one of the most important and most overlooked aspects for retail traders. Now, you might have heard, lots of different advice on the risk. Now, what I really recommend, particularly if you're struggling with trading and you just can't make consistent returns, over three-month periods, you're not making money, basically. If you're in that situation, or if you're struggling with large equity swings, or you want to manage money professionally for others, then could I recommend that you trade without leverage? Okay, so trading without leverage would look like this. If you have a $1,000 account, trading without leverage would look like this, 0.01 trade size. Okay, if you had a $100,000 account, to trade without leverage, you'll be trading with 1 lot sizes. You can still make double-digit returns in a year, but with using minimal leverage. So trading for the ASAC fund, the maximum amount of leverage that I was allowed to use for the fund was double the leverage of an unleveraged position. So I could use leverage to the power of 2. And that's absolutely fine. And the benefit of not using leverage is it makes it a lot calmer to think about your positions. It's a lot easier to leave your positions to run. You're not so concerned about losses as you would be if you're risking 10, 15, 20% of your account per trade. That's going to set off a whole snowballing effect that's going to be detrimental for your trading. So if you're struggling with your trading, try looking at your risk carefully and try trading without leverage. It might help you more than you perhaps realize, okay? So guys, thank you very much for attending. It's good to see some familiar names here. John, good to have you back. Aaron, Sammy, good to have you. Van, Yue, Olufemi, guys, great to have you. Now, you're welcome, John. I just want to flag up, next Tuesday, the webinar will not be occurring because I am speaking on CNBC Arabia. I spoke for CNBC last year, and they're going to have me once a month on the 2nd Tuesday of each month. So the 2nd Tuesday of each month, the workshop won't be on. So I just want to flag that up for you. So if you're putting it in your diary for next Tuesday, don't come back next Tuesday because I won't be here, but I will be back the following Tuesday. And of course, I will be back for the Monday for the FX week ahead. Okay, guys, thank you very much. A very happy new year to you all. It's good to be back in the saddle, get rid of some of the Christmas pudding from my stomach and get back to a normal routine. And I hope you have a really good 2020. Yeah, thanks, guys. Thanks, John. Take care now. Bye.